Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors. Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this episode, I want to continue the discussion we've been having really about the environment, sort of the direction of the economy and what that all might mean for the markets. But in this update, basically, we have some new data. To take a step back, obviously, in a lot of ways, most investors are long-term in nature. For my team, we're developing, for example, long-term forecasts for the market, 20-plus year forecasts. We identify investment themes that we view for the very long term. And even when we're buying individual stocks, we're basically doing that with the intention of holding a position for 7 to 10 years. So all of our work, a lot of it focuses on long-term trends, but we always get the question, are we going to have a recession? Are we going to have a correction or a bear market? And of course, logically, the answer to those questions is always yes. And what people aren't asking us, are we going to have one? Because eventually you do. It's more, when are we about to have one, and how deep will these downturns be if we do, right? So that's kind of what's in focus. So anyway, to jump into it a little bit, there's a lot of discussion, obviously, about the Fed cutting rates finally after over a year, actually, in terms of keeping their Fed funds rate at the highest level that it's been. And an anchor to that has been, on one hand, the softening labor market, right? They have a dual mandate of watching prices and watching jobs. And so the softening labor market has its focus. But of course, that's also off the heels of what has been cooler inflation. So anyway, this week, we got a couple more inflation prints that I would just describe as they were just a smidge firmer than expected, but sort of contributed to a pretty lengthy period where the levels of growth, if you will, the levels of inflation are in line with their 2% target. To mention the specific numbers, the consumer price index with this latest print has averaged 0.17% on a monthly basis over the last 6 months. So that's, again, the average. The producer price index a little bit lower, 0.15% on average monthly over the last 6 months. And just to remind ourselves, the level of 0.17 is the monthly equivalent of the Fed's 2% target. So we've talked a lot about when the monthly numbers get down and hover around that level, that is really going to free up the Fed to start to take action. And so, in fact, that's what we've seen. Now, officials have been talking about it. We had Fed Chair Jerome Powell say, quote, "The time has come for policy to adjust," end quote. Another quote that we saw was from the Vice Chair and New York Fed President John Williams, who offered, quote, "It is now appropriate to dial down the degree of restrictiveness in the stance of policy by reducing the target range for the federal funds rate," end quote. And so, the bottom line is they're out signaling we're going to do it. Futures have priced in a quarter-point cut at the September meeting here in 2024, and then cuts in 7 of the next 8 meetings after that. So through next year, September 2025, a total amount of cuts, futures are pricing in of 2.5%. Now, when the Fed cuts rates, historically, sometimes that's been really expansionary, but other times it's really focused on trying to soften or mitigate an economic downturn. We think it's more in the latter camp, that we're seeing a significant evidence of a slowdown. And so, in anticipation of growth sort of slowing, and honestly, various metrics. So, for example, Bloomberg publishes a recession probability. They still have it at 30%. So the focus isn't so much to say, hey, let's cut rates to really drive things further in a positive direction. It's a little bit more, hey, we need to cut rates to kind of keep things under control and not flip into or roll over into a deeper recession. So with all of that, we've talked about the market being a little sensitive, and we could see some forces, as we discussed in the last episode, that could drive the market higher a bit. But in general, we're seeing some forces that likely will cause the market to kind of slow down, perhaps roll over and turn down a little bit, or continue to do that. And so to get into some of that data, for example, the PE ratio for the S&P 500 is roughly 19% above its 10-year average, right? So PE, that valuation metric, a little bit richly valued. We see essentially a reaction in the market, let's say with the Bloomberg Magnificent 7 index, where that index is down since it was sort of a turning point, July 10th, down a little over 13%. Off of what was a very strong cumulative return over the last year and a half prior to that or so. And, that's just the market kind of signaling, hey, maybe the AI optimism has been a little bit overdone. We've talked about that. And so that's another, soft sort of negative force is, hey, maybe we got to kind of slow down here. In any event, the other thing that's hard to focus on, both emotionally in terms of gauging the potential of events, is almost by definition something that's unexpected. What sometimes in the parlance of market talk, they're called external events. It's not related to the fundamentals of the economy or the fundamentals of the markets initially, but some external event that causes people to get spooked and the market to roll over. So think of things like a sizable cyber attack. That could really shake confidence in our infrastructure, or a credit crisis, right? Where we've talked a lot about these higher rates. We've talked about the stresses in the credit system. To the degree that sort of bubbles up and becomes more systemic, then that's a problem. We don't see that, but that's the unexpected event that could unfold. Or imagine, of course, we don't want this to happen, but if it's a super tight election, as I think we talked about in the last episode, and that spurs some violence, like local violence around the country or something, that wouldn't be good. People won't react well to that. And then finally, the obvious one is we've got a number of geopolitical and military sort of hotspots, so wars going on around the world in other areas where there's lots of tension. And to the degree we see military escalation, especially that involves major powers, in a more significant way, markets won't react well to that. So again, we don't mention all those things to say we believe they're about to happen. By definition, it's a low probability and it's unexpected. But when things like that show themselves, the market tends to get pretty sensitive. Anyway, so that's what I wanted to cover, is sort of just a continuation of that discussion to say, look, we've gotten some good inflation numbers. That's great. That sort of feeds that idea that the Fed's going to start to cut rates, which as we've analyzed things and watched things slow down and watched their messaging, we think they will start, but that maybe the market's still overdone in terms of how much, but we'll see. We'll see how it unfolds. And then in turn, what that means in terms of the economy, the goal of a soft landing rather than a recession, and the idea that, equities have run strongly this year and last. And so, we know that things may slow down a little bit and we may see some volatility, especially in the near term. So anyway, thanks so much for listening to this episode, and we'll catch you on the next one.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.